Welcome to my 5-minute take on investing for minor children. The first important thing to think about is risk and diversification. We encourage anyone who's looking at investing to make sure they think about having funds set away in a buffer or rainy day fund. Now, this is not as important for perhaps a minor child, although it might be if they're older, towards 18. But really, the fundamental thing to be thinking here is that these funds will be locked away in investments for a good 5 to 7 years at a minimum. So you really don't want to be having to draw on those funds. The second thing is that we really encourage anybody to invest a lump sum in tranches and to stagger it into the market. While it's tempting to time the market, we generally look at staggering over 3 to 4 tranches, maybe of weeks or months, and the more volatile the market is, the more you're going to want a tranche. And thirdly, we encourage anyone investing to diversify their wealth. We really don't look to be trying to pick a few winners in terms of a few specific stocks, but really look at diversifying across asset classes depending on what your risk profile is. When you're looking at the funds and considering how you might invest, broadly 2 options that you might consider for diversification are exchange-traded funds and managed funds. Now, an index fund, which through an ETF, for example, is quite a good option if you're looking to get a diversified portfolio at a low cost. Index funds can broadly be grouped into broad index funds, for example, those that invest in the Australian market in line with the market capitalisation of companies, or a sector-based index fund, so you'll find them now in a tech sector or a healthcare sector, or a diversified index fund, which invests in a range of growth and defensive assets. So, for example, many of the investment houses, Vanguard, BlackRock, have a diversified index fund for each kind of level of risk profile. So perhaps there are growth index funds which tend to have sort of 80% in growth assets, or more conservative index funds that could be, say, 30% in growth assets. So I've already mentioned Vanguard and BlackRock. Another one that's in Australian companies, BetaShares. There's a number of them. So you would do your research. These are just a couple of the perhaps well-known ones. The other thing is that you can either invest on a brokerage platform. The common ones are by the major banks. There are others now, and Vanguard itself has its own platform that you may want to consider if that's the way you're going. It really depends on costs, whether you want to pay an administration fee or whether you want to pay brokerage in that case. Managed funds is another option. These are actively managed by a portfolio manager, which means there's somebody there making active decisions about how to invest rather than a computer algorithm that is based on mandates, such as an ETF which invests in the Australian share market in line with market capitalisation, for example. It also means that the costs of a managed fund are more than an exchange-traded fund or an index fund. And you can't buy managed funds on a brokerage platform. You need to buy them directly with a portfolio manager or to use a wrap platform. For platforms, some of the considerations: you can buy exchange-traded funds on the ASX, the Australian stock market, via a brokerage platform, but you can't buy managed funds. Although there are now some active fund managers. Magellan is one of the examples recently that now offer managed funds as an exchange-traded fund that can be bought on the ASX. Wrap platforms, Netwealth, Macquarie, BT, MLC, CFS, some of them, offer the option to buy managed funds as well as exchanged funds, but they come with platform costs to be mindful of. Vanguard Personal Investor is another one that I mentioned before that's relatively new, but it does not yet offer accounts for minors or informal trusts, but it's indicated they've indicated that they plan to offer that in the next 12 months. And one of the reasons that might be worth considering is that the platform might be quite cost effective to invest regularly, month by month, when it doesn't have brokerage fees on some of its products, as opposed to the brokerage on a brokerage account. Tax considerations is the final one to think about. You can buy the investments in your own name as an informal trustee. There are many other options to consider, but this is one that you can consider. And you can either quote your own tax file number if you are paying the tax, or the child's tax file number if they are going to be paying the tax. There's more information on the ATO website about how this works. It's worth noting that minors pay a higher rate of tax on their passive income, but because tax is only paid on income or realised capital gains, if you have low turnover and a high allocation to shares, this may not be so high, something that may be worth getting advice on. I hope that's been helpful.